Hello, WealthWise community. Welcome back to another episode where we delve into the world of wealth creation. If you're new here, don't forget to subscribe and hit the notification bell so you never miss an update. Today, we're talking about a topic that's crucial for anyone stepping into the world of investing: top stock market strategies for beginners. I'm your host, and together, we're on a journey to financial wisdom. Let's dive in. Before we jump into the strategies, let's take a moment to appreciate the significance of investing in the stock market. The stock market has been a historical engine of wealth creation, outperforming many other investment options over the long term. However, the journey into investing is not without its challenges. It requires a nuanced understanding of the market, strategic decision-making, and most importantly, a disciplined approach. Today, we're not just scratching the surface. We're delving deep into actionable strategies that will set you on the path to financial success. So, let's get started. Section 1. Understanding the basics. Importance of education. Education is the bedrock upon which successful investing stands. As a beginner, immersing yourself in the fundamentals of the stock market is paramount. Start with the basics: how the market functions, the mechanics of buying and selling, and the role of brokers. A solid understanding of key financial terms, such as earnings per share, EPS, price-to-earnings ratio, and dividend yield, will empower you to make informed decisions. Consider this your initiation into the language of the financial world. Risk tolerance. Understanding your risk tolerance is not just a theoretical exercise. It's a crucial self-assessment. Your risk tolerance is not static. It evolves with your financial situation and life circumstances. It's the emotional fortitude you have when faced with the inevitable market ups and downs. Assessing your risk tolerance involves considering your financial goals, time horizon, and psychological makeup. Are you comfortable with the potential for higher returns accompanied by higher volatility? Or do you prefer a more conservative approach? This introspection lays the foundation for crafting an investment strategy aligned with your comfort level. Setting financial goals. Goals provide direction, and in the world of investing, they are your North Star. Take the time to define your financial goals, both short-term and long-term. Whether it's saving for a down payment on a house, funding your children's education, or securing a comfortable retirement, each goal will shape your investment strategy. Understanding the time horizon for each goal allows you to tailor your investment approach. Short-term goals may warrant a more conservative stance, while long-term goals can accommodate a more growth-oriented strategy. Section 2. Building a diversified portfolio. Diversification is the art of spreading risk, and in the realm of investing, it's your shield against unforeseen challenges. Beyond merely investing in different stocks, diversification extends across asset classes, stocks, bonds, and other securities. This multifaceted approach is designed to minimize the impact of a poor-performing investment on your overall portfolio. It's akin to planting a diverse garden. If one plant falters, the others thrive. Diversification is not about avoiding risk altogether, but strategically managing it. Asset allocation. Asset allocation is the science behind balancing risk and reward. While there are standard guidelines like the 60-40 rule, allocating 60% to stocks and 40% to bonds, your asset allocation should be a personalized decision. Consider your age, risk tolerance, and financial goals. Younger investors with a longer time horizon may lean towards a higher percentage of stocks for growth, while those closer to retirement may opt for a more conservative mix. Asset allocation is not a one-time decision. It evolves with changes in your life and market conditions. Section 3. Long-term investing. The power of compounding. Compounding is the unsung hero of wealth accumulation, turning the principle of time is money into a tangible reality. The concept is simple yet profound. The earlier you start investing, the more time your money has to grow. Compounding is the force that transforms a modest investment into a substantial nest egg over time. It's not just about earning interest on your initial investment. It's about earning interest on the interest, creating a snowball effect. This underscores the importance of starting your investment journey sooner rather than later. Buy and hold strategy. The buy and hold strategy is not merely a passive approach. It's a philosophy grounded in the belief that, over the long term, the stock market tends to rise. Instead of trying to time the market's twists and turns, the buy and hold strategy encourages investors to identify solid companies and stay invested through market fluctuations. This strategy requires patience and discipline. It's about seeing beyond the daily market noise and focusing on the fundamentals of the companies in which you've invested. Successful investors understand that it's time in the market, not timing the market, that matters. Section 4. Research and due diligence. Fundamental analysis. Fundamental analysis is the investor's toolkit for peering beneath the surface of a stock. It involves a comprehensive examination of a company's financial health, management team, competitive position, and growth potential. This analysis delves into financial statements, earnings reports, and relevant financial ratios. Fundamental analysis allows you to distinguish between companies with a strong foundation and those with vulnerabilities. It's not about chasing stock tips, but about making informed decisions based on a thorough understanding of the businesses in which you invest. Stay informed. The stock market is a dynamic ecosystem influenced by a multitude of factors. Staying informed is not a one-time effort, but a continuous process. Regularly review your portfolio to ensure it aligns with your goals, and stay abreast of market trends, economic indicators, and global events. This doesn't mean succumbing to the temptation of constant portfolio monitoring, which can lead to impulsive decisions. Instead, focus on understanding the broader factors that shape the market. A well-informed investor is equipped to navigate the ever-changing landscape of the financial world. Section 5. Risk management. Setting stop-loss orders. In the tumultuous seas of the stock market, risk management becomes your anchor. Setting stop-loss orders is a proactive strategy to protect your capital from significant downturns. A stop-loss order is an instruction to sell a stock automatically if its price falls to a predetermined level. This tool ensures that your losses are capped, preventing emotional decision-making during market volatility. Implementing stop-loss orders is not an admission of defeat. It's a disciplined approach to safeguarding your hard-earned money. Emergency fund. Before immersing yourself in the world of investing, establish a financial safety net, an emergency fund. This fund, typically equivalent to 3 to 6 months' worth of living expenses, acts as a cushion during unexpected financial challenges. An emergency fund provides peace of mind, ensuring that unforeseen expenses won't force you to liquidate your investments at inopportune times. It's a foundational element of financial security, allowing you to weather unexpected storms without compromising your long-term investment goals. Section 6. Harnessing technological tools. Robo-Advisors. In the age of technological advancement, investing has undergone a revolution thanks to the emergence of Robo-Advisors. These automated investment platforms utilize algorithms to create and manage a diversified portfolio tailored to your risk tolerance and financial goals. Robo-Advisors provide an accessible and cost-effective way for beginners to enter the world of investing without the need for extensive financial knowledge. They offer a hands-off approach, combining the efficiency of technology with the principles of sound investment strategy. Investment apps. Investment apps are the gateway to the stock market in the palm of your hand. These applications not only facilitate the buying and selling of stocks, but also provide a wealth of information and educational resources. Many investment apps are designed with user-friendly interfaces, making them ideal for beginners. The beauty of investment apps lies in their accessibility. You can start investing with small amounts, making it an inclusive option for those who want to dip their toes into the world of investing. Section 7. Tax-efficient investing. As we navigate the landscape of investing, it's crucial to shine a spotlight on the often underestimated but immensely significant aspect of tax-efficient investing. Taxes can erode your returns, but with thoughtful planning, you can minimize their impact and keep more of your hard-earned gains. Understand tax implications. Before executing any investment strategy, it's essential to understand the tax implications of your decisions. Different types of investments may have varying tax treatments. For instance, capital gains from stocks held for over a year may qualify for lower tax rates, while short-term gains might be taxed at your ordinary income rate. Be aware of the tax rules surrounding dividends, interest income, and capital gains, and consider these factors when making investment decisions. Tax-advantaged accounts. One effective way to mitigate tax impact is by leveraging tax-advantaged accounts. These accounts, such as individual retirement accounts, IRAs, and 401(k)s, offer tax benefits that can significantly enhance your overall returns. Contributions to these accounts may be tax-deductible, and your investments can grow tax-deferred until withdrawal. Understanding the rules and contribution limits of these accounts is key to optimizing their tax advantages for long-term wealth accumulation. Tax loss harvesting is a savvy strategy that involves selling investments that have experienced losses to offset gains in your portfolio. By strategically realizing losses, you can minimize your taxable income. It's a method that requires careful planning and adherence to tax regulations, but when executed effectively, it can enhance your after-tax returns. Keep in mind the wash sale rule, which prevents you from buying the same or a substantially identical investment within 30 days of selling it for a loss. Consideration of dividends. Dividend income is a key component of many investors' portfolios, providing a steady stream of cash flow. However, it's crucial to be mindful of the tax implications of dividends. Qualified dividends may be eligible for lower tax rates, but non-qualified dividends may be taxed as ordinary income. Understanding the tax classification of dividends and incorporating this knowledge into your investment strategy can enhance your overall tax efficiency. Recap. Our journey through the top stock market strategies for beginners has been a comprehensive exploration of the fundamental principles that underpin successful investing. To recap, successful investing requires education, a clear understanding of your risk tolerance, well-defined financial goals, a diversified portfolio, a long-term mindset, thorough research and due diligence, effective risk management, and leveraging technological tools. Remember, wealth building is a journey, not a sprint. Let's apply these strategies wisely for a prosperous financial future. If you found this deep dive valuable, be sure to give this video a thumbs up and subscribe for more insightful content from WealthWise. Your engagement is what fuels the growth of our community. Share your thoughts and questions in the comments below. We love hearing from you. Together, we're on a journey to financial wisdom. Until next time, stay wise and wealthy.